Your first hiding place is a Chase savings account earning 0.01% interest. You have $2,400 in it. You are 24 years old, and this is where you put money when you are afraid to spend it. It earns $0.24 a year. Inflation is running at 3.8%. In real terms, your savings account is not protecting your money. It is slowly dissolving it. You don't know this yet. You think the number staying the same means the money is safe. The number staying the same while purchasing power declines is not safety. It is a slow leak with a stable-looking gauge. You move the money. Not because you learned this in school. Because you read something at 11 p.m. on a Wednesday that made the math visible for the first time. The money moves to a high-yield savings account at 4.8%. Same $2,400. Same stability. $115 a year instead of $0.24. The account is FDIC insured. Nothing changed about the risk. Everything changed about the return. That was your first real financial decision. It cost you nothing except the 10 minutes it took to open the account. You are 27. You have $18,000 saved. The high-yield account holds your emergency fund, 6 months of expenses exactly. The rest sits in a target date fund inside your 401k. You do not think of this as hiding money. You think of it as saving. The distinction will matter later. Right now, the 401k is doing something you cannot fully feel yet. Every dollar entering it reduces your taxable income in the year it enters. Every dollar inside it grows without annual tax friction. You are deferring the tax conversation to a future version of yourself who will presumably be in a lower bracket. You are 31. The emergency fund is still in the high-yield account. The 401k has $67,000 in it. You have opened a Roth IRA and maxed it for 3 consecutive years. The Roth is a different kind of hiding place. Money enters after tax. It grows tax-free. It exits tax-free. The IRS never touches it again after the contribution. You are paying tax on the seed to avoid paying tax on the harvest. Whether that trade is correct depends on your future tax rate. You are betting it will be higher than it is today. That is a reasonable bet for someone at 31 with income rising. You also have a taxable brokerage account now. $14,000 in index funds. No tax shelter here. Dividends are taxable in the year they arrive. Gains are taxable when you sell, but there is no contribution limit, no withdrawal restriction, no penalty for accessing it at 35 instead of 65. The taxable account is liquid in a way the retirement accounts are not. You are building access at multiple time horizons simultaneously without fully naming what you are doing. You are 35. You own a home. This is where the hiding gets structural. You put 20% down on a $320,000 property. $64,000 of your savings converted into an asset that appreciates outside of any tax account. But the first $250, $000 of gain on a primary residence is excluded from capital gains tax when you sell. You are living inside a tax shelter. You pay property tax and maintenance, and the occasional repair that arrives without warning on a Saturday morning. In exchange, you are building equity in an asset that has averaged 4.1% annual appreciation nationally over the past 30 years. You are 38. The accountant introduces a SEP-IRA. You have been doing freelance work on the side. $47,000 last year, outside your W-2. The SEP allows you to contribute up to 25% of net self-employment income. You put in $11,000. That $11,000 does not exist for tax purposes this year. It enters a tax-deferred account where it will compound without friction for decades. You have now built 4 separate containers for the same money to live in. Each one has different rules, different access schedules, different tax treatment on the way in and on the way out. You are 41. Your net worth crosses $800,000. Most of it is invisible on any single document. The home equity does not appear on a brokerage statement. The 401k balance does not appear on a tax return. The Roth IRA grows in complete silence from the IRS perspective. The taxable brokerage is visible, but its unrealized gains are not yet a tax event. You are sitting on a significant amount of accumulated value, and almost none of it is in a checking account. This is not accidental. It is the result of a decade of routing decisions made at the moment of each dollar's arrival. Where does this go? That question asked consistently over 10 years produces the number you are looking at now. You sit with your CPA for the first time in a conversation that is not about filing. It is about structure. She asks about your income sources. She asks about your timeline. She asks whether you have considered a backdoor Roth conversion given that your income now exceeds the direct contribution limit. The backdoor Roth is a two-step process. You contribute to a non-deductible traditional IRA. You immediately convert it to a Roth. The result is Roth dollars at income levels above the eligibility threshold. The IRS allows this. It has a name that sounds like a loophole because it functions like one while being entirely legal. You do it. $7,000 more per year into the tax-free bucket. You are 44. The business you built on the side is now generating $280,000 a year. You elect S-corp status. Your salary is set at $95,000. The remaining $185,000 flows as distributions. Distributions carry no self-employment tax. That 15.3% does not apply to the distribution amount. One election, one filing, $28,305 in self-employment tax. Not paid in the first year alone. The money did not move. The vehicle it traveled through changed. You open a solo 401k through the S-corp. Total annual contribution, $66,000. That is $66,000 removed from taxable income in a single year through a structure available to any self-employed person who knows it exists. You are 47. Your accountant introduces cost segregation on the rental property you purchased 2 years ago. A cost segregation study breaks the property into components, each with a shorter depreciation schedule than the standard 39 years. The accelerated depreciation produces a paper loss in the current year. That paper loss offsets real income. The property generates cash. The paper says it costs money. Both are true simultaneously. The tax code was designed to incentivize real estate investment. You are being incentivized. You are 51. Your attorney introduces the donor-advised fund. You have $40,000 in a stock position with a cost basis of $8,000. If you sell it, you pay capital gains tax on $32,000. If you donate the shares directly to the fund, you receive a deduction for the full $40,000 fair market value. The fund sells the shares with no capital gains tax. You avoided $4,800 in capital gains tax and received a $40,000 deduction in a high-income year. The charity received more than it would have if you had sold, paid tax, and donated cash. Every party received the optimal outcome. The tax code built this. You used it. You are 54. The family limited partnership holds your real estate interests and a portion of your investment portfolio. When assets transfer, they transfer at a valuation discount because limited partnership interests are illiquid minority positions. The IRS allows a 20 to 35% discount on fair market value for gift and estate tax purposes. The assets are moving to the next generation at a fraction of their taxable value. The tax code anticipated this structure. It priced it. You are operating inside the price it set. None of this was taught in school. None of it required a higher income. It required knowing the containers existed and understanding which one each dollar belonged in at the moment of its arrival. Somewhere, a 6-year-old has $4,200 sitting in a checking account earning nothing. The containers are available. The distance between where his money is and where it could be working is not income. It is information. That information is now in front of you. The clock is running. The containers are open. The question is only whether you know which one to use first.